In the world of algorithmic trading and automated strategy production, the goal is to simplify the most complex strategies while ensuring that the results are adaptable to all types of markets and timeframes. In summary, adapting all these variables as simply as possible to achieve good long-term results. In today's video, we'll guide you step by step through a strategy that combines different indicators but has a unique twist, a special touch. Welcome to Game of Traders. And yes, as you can see, we have created a new Telegram community, completely free, where we will be posting all the updates about what's happening in the financial markets, as well as trading operations, analysis, and much more valuable content. You can find the link directly in the description. As you can see on the chart, I have Heikin Ashi candles marked, and we'll teach you this strategy using both this candle type and standard candles so that you can choose the one that best suits your current trading style. This strategy is specifically geared toward medium and lower time frames, focusing on day trading and scalping. A favorite time frame for most traders is the 15-minute one. So the first step is to locate the Keltner channels indicator on Tradingview. And we're not just going to click on it once, but twice, as we'll need to have two of the same indicators but set up differently. This is why I mentioned that this strategy is a bit different. However, just this one indicator with varied settings can provide the specific information we need. In the first one, we'll change the length from 20 to 50 and adjust the multiplier from 2 to 3.75. Pay close attention to this. Not 3 or 4, but 3.75. In the style section, we leave everything as it is, though we can remove some options to clean up the chart. Click OK and let's configure the second one. Again, set the length to 50, but set the multiplier to 2.75. In the style section, to differentiate both indicators, even though they are the same, we'll make the lines red. Again, we remove these options, and in the background part, we'll also set it to red for quick visual distinction. You can also change the middle line color on both indicators, setting it to white if you prefer, although it's not essential for this strategy. We're primarily looking for and exploiting these types of trend reversals. Returning to the indicators, search for volume. We'll use the volume indicator provided by Tradingview, which, while simple, offers a lot of valuable information. In this volume indicator, we'll just add a moving average to this volume. We can, for instance, set it to yellow and remove these options again to keep the chart clean. At this point, we already have plenty of information to operate with. The key is to identify zones like this one, where in a trend movement, such as an uptrend, we see a wick extending beyond the outer Keltner channel and a candle closing close to this upper blue line. The closer the candle body closes to this upper blue line, the better the signal. We simply wait for this candle here, the first red candle that crosses the inner red line of our channel, and place our trade right at the close of that candle. Depending on the asset's volatility, we set our first take profit with a shorter or more extended ratio. In this case, trading Bitcoin, we might look for a 1.1 ratio to take partial profits, then a 1.5.1 ratio, and even let the remaining portion run until we see a possible trend reversal, simply closing when the Heikin Ashi candle structure changes color, for instance from red to green. Another option is to take profits at the midpoint of the channel, where that inner moving average will always act as support or resistance, depending on the position. However, our entry shouldn't be based solely on these two rules. When we see a candle close near the upper channel line, blue in this case, and then look for entry with the first red candle crossing the red channel. This should also be accompanied by significant volume. For example, in this first red candle crossing into the red channel, we also see volume above the average, validating our entry. As you can see, we could gain decent profits here, but the most important part is pinpointing the perfect reversal zone. All this information can help you not only to find good trades with this specific strategy, but also to enhance your own trading by adding more data. If we move a bit further, we can see how an uptrend starts to form, but there's never a perfect sell signal, meaning it also provides information on when not to go short, helping filter out false trades. For instance, after these candles close near the upper blue line, the first red candle we have that crosses into the lower red channel shows no volume above the average, thus invalidating the trade. Continuing, we see many examples where the first red candle doesn't provide a good short entry due to the trend continuing upward, saving us from potential losses. When the second rule is finally met, the red candle has already reached the middle zone, so we avoid shorting here because this Heikin-Ashi candle, corresponding to this area, has already touched the middle zone, and we don't want to short against this support. However, this strategy also works well with standard candles. Further ahead, we see a candle body closing near the outer blue line, but the next candle, green, crosses into the red channel, and volume is also above average. This is an ideal entry. We place our stop loss just below the previous lows, and the first take profit is at the middle line, which here yields a 2.1 ratio. The rest can be left to run, or if using a trailing stop, the trend can be fully exploited, resulting in an incredible trade with a 133.5.1 ratio. If we move further down, another candle closes near that blue line. The next candle, red, crosses the red channel, and volume is again above the average. We set the stop loss and take profit up to the moving average line. A bit further, another green candle touches the blue line. The next candle reverses and crosses from the blue to the red channel with high volume, and again we place our stop loss, first take profit at the middle line, and the rest can be trailed. As you can see, it works very well, especially because we can support it with other indicators, some as simple as the RSI. The RSI not only marks overbought or oversold areas, but also highlights divergences between price and asset strength. Here we see that price keeps falling while the RSI rises, suggesting an entry point. We could interpret this as a potential buy setup with the first red candle near the blue line, followed by a green candle with high volume. This close proximity to the moving average could mean we skip the trade, but with the RSI strategy, we can open a lower capital, low leverage trade, or even one without leverage. We might repeat this if another divergence appears, where a candle body closes near the blue line, followed by another green candle entering the red channel. With a third divergence, we repeat the process. And below in the description, you have the direct link to our website, AlgoTraders, where you can get the best indicators on the market for trading in Forex, cryptocurrencies, stocks, or any type of asset. Supported by artificial intelligence, these indicators are capable of adapting to market information and identifying the perfect entries for your trades on a daily basis. If you're not yet as profitable as you'd like to be, switch to AlgoTraders indicators and you'll be able to achieve it while trading any type of asset. Additionally, in our community, you'll be accompanied not only by our mentors and professional traders, but also by the more than 500 people who are already taking advantage of this opportunity.